attention, please. It's my job to introduce our keynote speaker today, Dr. Mark Dotzour. Here's just a little bit about him. Mark is a real estate economist who has served for 18 years as the Chief Economist for the Real Estate Center at Texas A&M University in College Station. Mark has been the keynote speaker for CCIM and SIOR, the national conventions. I know you're going to enjoy his combination of intelligence and wit. Please join me in giving Dr. Mark Dotzour a warm applause.
Thank you. It's a pleasure to be here today. This area is just absolutely gorgeous. I can see why you enjoy living and working around here. Thank you for inviting me to be here. I do this about 80 times a year and speak to a lot of commercial real estate professionals all over the country. And so it's a privilege for me to be here today. The time that I have with you today, I'm going to be focusing on two things. Lots of issues, but two fundamental issues. I find that commercial real estate professionals are largely interested in two things. Number one, are my buildings going to continue to fill up? And number two, what's likely to be the value trend of buildings in my market? So everything I talk about today is going to be addressing those two issues. I got to warn you, I don't do Zig Ziglar power positive thinking, let's put some lipstick on a pig and sell something speech. And I don't have any self-esteem, so I don't care if you do either by the time we're done, okay? That's not what I'm here for. What I am here for, I hope, my goal is to provide you with some information that might help you understand your clients better and help you and your family and your business make better business decisions in the world that we live in today. The other thing I should say is that I was born in Kansas. They don't have Democrats in Kansas, so I was born a Republican. But about 6 years ago, I changed parties, and now I'm a registered cynic. I don't believe any of them, okay? And I don't like any of them, not only just don't agree with them, okay? I voted for Gary somebody. I think he was the Libertarian candidate. I was hoping Mickey Mouse would have been on there because at least I know Mickey, but I voted for Gary because I didn't like any of the other candidates, period. I will talk about federal policy though, because as a business owner or investor, you cannot ignore federal policy. So I'll be talking about policies and that sort of stuff. So just check your politics at the door. I don't care if you're a Republican or Democrat, it means nothing to me. I'm just interested in trying to figure out what Washington's trying to do and how that'll impact business decisions. And lastly, I want to mention to you also that I am an economist. And what that means is there's a 50% chance anything I say could be completely wrong. Okay? But for $500,000, you could have got Greenspan or Bernanke here, and their odds aren't any better than mine. So I'm not apologetic for that. So with that said, I wanted to start off by saying, for most of last year, my theme of my speeches was playing ball in the later innings, because a lot of people would come up to me after a speech and say, hey, what inning are we in? And when a business person asks you that, what they're really asking is, how long is it going to be before we have a recession and we start having negative job growth and negative absorption in space and all of that stuff? So after hearing that enough, I titled my theme last year, Playing Ball in the Later Innings, because I felt like we're getting closer. The longest expansion since World War II is 120 months. And we're sitting at about month 95 right now. So we're out there getting close to the longest expansion since World War II. With that said, at that time, this was before the election, of course, all last year, I was saying I think we're in about the 6th or 7th inning. I think we got another 2 years to run or so. And then we had an election. And I tried to ignore it up until it happened. And then once it happened, then I decided, okay, now what do? I got to figure out what this means for business people. And what my experience was, I gave a speech the day after the election. I do about 80 of these all over the country. And virtually every business you can think of, I visit with, and when I'm at tables like this, I'm not really interested in your children or your grandchildren. I always direct conversation to business. I want to know what you're seeing in business. I was overwhelmed with the optimism that I saw the day after the election. I didn't expect to see it, but it was palpable. And I thought, well, maybe that's just Vegas, or maybe that's just Charleston, or maybe that's just Miami. But I'm telling you, everywhere I go, and I'm not exaggerating, everywhere I've been, the businessmen and women in this country are giddily ecstatic about the election. They have been since November 3rd. With that said, I want to mention to you that you might not feel that way if you watch TV too much. I've been telling audiences for the last 5 years, if you're watching Fox News or MSNBC, whichever one you think's the best, if you're watching that stuff more than 7 minutes a day, not only are you wasting your time, but you're causing yourself emotional damage in the process. And I'm warning you now, it's worse than that, because if you're watching, I don't watch it at all anymore. Because if you're watching, if your view of the world is shaped by what you see on any media outlet, period, you're going to be underestimating what's going on in this country. Because these national media are making it out our country's just in terrible shape, our government's horrible, everything's splintered, so many people not working. I'm just telling you, it's not just a matter of just making you mad watching anymore. I'm telling you, if you're making business decisions based on what you're seeing on CNN right now, you're going to be making big mistakes. Because our country is an entirely different scenario in the business community than what you're seeing on TV. So just be careful with that. I don't watch it anymore. I don't watch it at all. And I'll tell you, I don't need to, because if you're a business person and you want to stay informed, I have to be informed. If I'm not, you will never invite me back again. I stay informed without any of those media, period. Between the Wall Street Journal and Reuters, that is a true news outlet. Between those two, you can get actual news that gives you actual information about what's going on without political motivation or whatever their political motivation might be. So I would just give you that advice. Those are good sources to stay informed if you want to, and just watch the rest of that stuff at your own peril. So anyhow, as I saw the optimism after that election, I was kind of surprised. And then as I saw that around the country, I thought, well, okay, are we still in the later innings? And then I hear Donald Trump saying we're going to cut taxes and we're going to build $1 trillion worth of bridges and we're going to reduce regulation, all kinds of things that make business owners excited. See, presidents don't create jobs. Congress doesn't create jobs. Barack Obama didn't create a job. George Bush didn't create a job. You know who creates jobs? You do. Your neighbors do. The people that hire people. You create the jobs. These politicians don't. Here's what politicians are supposed to do. They're supposed to create an environment in our country that gives businessmen and women optimism so that they hire people. That's how our system works. Our media makes it out that this president created jobs. This president doesn't create jobs. That's just the ignorance that you see in the media. Just be careful about that. Like it or not, I don't like or dislike Donald Trump. I got no dog in the hunt with that guy. He's president of the United States. Like it or not, he's creating an environment that is causing businessmen and women in this country to have some optimism right now. And so I'm seeing that, and when I saw that, I thought, wow, so what's the theme of my presentation going to be for 2017? And I came up with this idea of approaching the red line. And I mentioned that to my wife. She travels with me a lot. Not this time, unfortunately, but I said, I think the theme's going to be approaching the red line. And she goes, I honestly, I don't know what the red line is. And so I thought, well, a lot of people probably don't. So I went to a dictionary online just for fun. I got one at home in my office that I rely on, but just for fun, I went online. Here's the Urban Dictionary. A red line is the amount of RPMs that your engine can put out before you pretty much blow it up. And a car guy in Miami told me, no, that's not quite right, because if you go past the red line, your car will blow up. So I want to explain to you what I mean by that, because it has largely to do with the fact, I'll summarize it right now, our country is at full employment. We have a gigantic labor shortage in this country, and that can create inflation. That is my theme today, because for the last 8 years, since about 2008, I've been saying we're not going to have any inflation in this country. And people would go, well, yeah, we are, because the gold dealer that I buy my bullion from told me our government's printing $4 trillion and we're going to have runaway inflation, and I need to buy gold. And I need to buy a lot of ammunition to support my gold. Okay? I heard that over and over and over. And I've been saying to people, it's like, if you think we're going to get, well, number one, how many of you still use an HP 12C? Anybody want to admit it? I was old enough to use them. Okay, the reason I ask is because I'm finding a huge correlation between people that own an HP 12C and people that are worried about runaway inflation. It's like the calculator's got a button on it. If you push the wrong one, it goes, runaway inflation will happen in 42 hours. Buy gold and ammunition tomorrow, okay? And I've been telling people since 2008, it's like, if you're even thinking about buying gold, I would recommend you just take cocaine instead, because at least you'll feel good before it kills you. And back in the day when I was working at A&M, I'd have to say, and that's not an official position of Texas A&M, because I had the dean down there one day, and he's like, oh my God, what did you just say? But I don't work at A&M anymore, so I don't care what their official position is on anything anymore. It doesn't mean a thing to me. I was telling people at the time, if you're even worried about runaway inflation, there's ways to do that other than speculating in a commodity. Number one, you could buy inflation-protected treasury bonds. They're indexed to inflation. That's a good opportunity. Number two, you could buy apartments because the leases are only 12 months long. If you get in an inflationary environment, you want real estate that has a short-term lease. What else has a short-term lease in real estate? Storage units. I asked some storage people, what's your lease term on that? 30 days. If you have an inflationary event, you're charging $100 a month for storage, have a bad inflation event happen, you change it from $100 a month to $100,000 a month, and the client pays it willingly because their wages went up by exactly that amount too. Perfect hedge against inflation. And another one was crop producing farm ground. This year's wheat crop or corn crop might be $4 a bushel. Next year, bad inflation event happens, it's $4,000 a bushel. So you've got inflation hedge. If you've got a real estate investment that's got a long lease term on it, that's not near as attractive. If you have a 10-year lease on some building at $30 a square foot or whatever, you're stuck at $30 a square foot for the next 10 years. That is not much of an inflation hedge. So those were my advice to people that were worried about it. But then I was turning around saying, we're not going to have runaway inflation in this country. Interest rates aren't going to go up. In 2013, you heard from a lot of smart people at Harvard and MIT, other places like that, that the Federal Reserve is going to taper their bond purchases and interest rates are going to go up, and it's going to kill the housing market, and it's going to make cap rates on commercial real estate go up. You better sell your buildings now. And I was going all over the country begging people, whatever you do, don't sell your buildings, because these people think interest rates are going to go up, because they're not. And I want to build out that case why, and why I think they're still not going to go up. I know you're hearing that too. Oh, the Fed's going to raise rates, and that's going to make mortgage rates go up, and that's going to hurt the housing market, and it'll make cap rates go up too. Well, I personally don't think that's going to happen either. I know I'm an outlier. I don't come up and go, well, the 50 blue chip economists in America think on average that something's going to happen. That's no fun. I would never do that. It's a waste of my time. I just do my own thing. And like I said, a 50-50 chance anything I say is wrong. It's just for 19 years, people have been inviting me back year after year after year too. So I'm due for a big miss, so this could be the year. This could be the year. If cap rates go to 12% on retail next year, call me up and go, Mark, how was that call? Hey, nice job. Come back in like another 100 years. Approaching the red line. Come on. This is what I saw the economy looking like in 2006. Car metaphor. That dragster is pretty powerful, but it's on fire. It's not supposed to be on fire. That's what happens when you put too much something in the gas tank. It's not supposed to be there. That something in 2006 was making 107% loans to people buying houses without verifying they had any income, any credit, or any job. Liar loans I don't know why we made them. George Bush was president. It was a neat idea. I called it a grand social experiment. This is going to be really interesting to see. Make a 107% loan to somebody that doesn't have a job, got bad credit, no money. Be interesting to see how it works out. Well, in my mind, that's how it worked out. And that's why we've had 0% interest rates and mortgage rates of 3.5% for the last million years. Now, with that said, then the next year, this is what I thought the economy looked like. This is when Ben Bernanke was begging Congress for fiscal policy. Men and women of the Senate, men and women of the House, we need fiscal policy in this country. We need jobs. The American people don't know what fiscal policy is. They'll say, oh yeah, it's physical policy, right? We need some of that, physical whatever. Bernanke should have looked at the audience out there after he looked at Congress. He should have looked right in that TV camera and said, do you hear what I said, folks? I'm begging these people for fiscal policy. Do you know what that means, really? What that means is these congressmen, these senators are failing you by not creating an environment that's causing confidence to happen in businessmen and women around this country. That's who's failing the country. But unfortunately, Congress couldn't do anything. The president wasn't interested in it. Congress wasn't interested in it. We didn't get any fiscal policy. It wasn't on the agenda. Healthcare was on the agenda. Climate change was on the agenda. Other things were. Fiscal policy to create jobs, what? At least it wasn't a high priority. Now, so that's where we were. But how long ago was that? 8 years ago. This isn't 2009 anymore. Here's where the red line comes in, because now, as we said here, this is what I would have thought right before the election. This is where we were, a stronger economy that's creating jobs, and we have a labor shortage and wage increases that can lead to higher inflation, and in that case could lead to higher interest rates. The risk of inflation and higher interest rates is higher now than it has been for the last 8 or 9 years. There is some possibility because we have a labor shortage. You don't hear that on CNN, because our country is coming to an end as we know it, according to them. And the fact of the matter is, unemployment is at a record low again. And the fact of the matter is, we got all kinds of jobs open that can't be filled. I'm going to prove this in a minute. I don't expect you to believe me. I went to the University of Texas, and then I worked 18 years at their arch enemy, Texas A&M. I did some time at OU before that. I need to stop saying doing time at OU, because that means something different now in the post-Barry Switzer era. But I did do some time at OU, and I have a beard, so I don't expect you to believe anything I say. I totally understand that. So I'm going to show you the facts here. You can sort it out for yourself, but I'm just telling you what I see in these facts. I got to get this just right. I'm right-handed. I'm doing this left-handed. I love ambidexterity, and I'm still working on it. People ask me to come in and talk to their board of directors. Like I was at a big REIT in Real Estate Investment Trust, industrial REIT in Miami. They brought in their 20 regional managers from all over the country. They're working with Amazon for all those big new warehouses and all that. And they're doing their annual planning for the year. So they say, come in, talk to us for a while, and then leave so we can do our planning. So this is kind of what I did for their board. Things to think about in 2017. These are things that your customers will be thinking about, whether it's on the renting side or the leasing side, whether it's the owner side, the buyer side, the seller side. These are the kind of things that people are working through in their mind right now. Number one, our economy still has a lot of energy left. Our economy is the strongest economy on earth, period. It's where everybody wants to invest. Period. Money's flowing out of China like you can't believe. Do you know what they had to do to get money to keep from flowing out of China about a month ago? Our Fed funds rate that she's talking about raising, that's 0.5%, they had to raise the Hong Kong overnight rate to what? 60% one day. In the last 60 days, the overnight rate in Hong Kong went to 60%. That's what you do when all the money in your country is about to leave. It's like, hey, before you go, how about 60%? Will that work? Yeah, it worked. It's not as big of a problem right now. Money is flowing into this country. We're not growing all that fast, but we're the best, we're the strongest on earth right now, and we're going to be that way for quite a while. And as long as we are, money's going to continue to flow into commercial real estate. My retirement account, I'm 63 years old now. My retirement account is a 403B with TIA-CREF, the insurance company. And I got 85% of my retirement account in their commercial real estate account. And I've been there for about the last 6 or 7 years. They hate it. They make me sign off to go, you are not fully diversified. You're an idiot. If you lose a lot of money, you are not going to sue us. Sign this right here. So I pay a lot of attention to commercial real estate values. It's kind of funny though. Let me tell you something. As your clients start hem and hawing a little bit because cap rates are compressed and pretty low and stuff, my investment guy with TI Cref came back about a month later after looking at my portfolio, and I knew he was going to browbeat me and say, you need to have a diversified portfolio, small cap, big cap, blah, blah, blah. He came back in and he goes, he had his binder and everything. He goes, we did a Monte Carlo simulation. That's just a computer simulation of a whole bunch of different portfolios. Using Ibbotson and Sinkfield models, that's the state-of-the-art financial models. He said basically, using the best financial models that we got with a gigantic computer, we looked at 500 portfolios that we could offer you, and your portfolio had a higher risk-adjusted return than any portfolio that we have available to offer. Now what that tells you is that commercial real estate component of investment is the strongest aspect of all the investment world. I'm almost all in real estate, nothing else, no stocks, no bonds. I actually got 14% in junk bonds, 85% commercial real estate, 14% junk bonds. The only way I could have improved on my return on investment over the last decade would have been to have 100% in commercial real estate. And people know that. And large institutions are still figuring that out, and their appetite for real estate is still growing. I don't care what your cap rate is. If you got a multifamily cap rate that's under 2.9, you can surprise me. The lady at Beverly Hills 2 years ago came up to me and said, I just sold a multifamily here in Beverly Hills with a 2.9 cap. So that's the lowest one of those I've heard. So anyhow, we got a lot of energy left. The Fed's going to try to raise their interest rate all year this year. That's all you're going to hear. Every month, Janet Yellen's going to come out and say, we're going to raise rates next month. Next month, we are raising rates. Next month, we're going to raise rates again. That month after that, they actually do it. It's just going to be a cat and mouse game, constantly barraging you. I'm going to raise rates and I'm going to do it, raise it again. And why they do that in increments like that is because they're afraid that they kill the stock market. They can't raise them too rapidly and then worry that the stock market drops 15 or 20%. The last time that's similar to this was 1987. The Fed was raising interest rates a lot. They raised rates all through 1987, and then in October of 1987, they called it Black Monday, the Dow fell 22% in one day. Today, at today's level, that means the Dow would fall 4,500 points in one day. The Fed knows that they can do that, and they know that they don't want to do that. And so if you'll notice, in December of 2015, they tried to raise the rate. They raised it 0.25%, and the stock market dropped 10 or 12% a month later. And you notice they didn't even talk about raising rates all last year. Here they are back again now, talking and doing. If my guess is right, they'd like to get that Fed funds rate up to 2% tomorrow. If they could do it all in one swoop, just say, hey, we just changed our mind. We're raising it to 2% tomorrow. If the stock market would allow them to do that, they would probably do that. This way it is now, they're going to do this cat and mouse game, sneak up, let's get it up as quick as we can. But the Federal Reserve does not control the interest rates on home mortgages or the mortgage rates on interest rates on 10-year treasuries, which are influencing cap rates. Don't let anybody tell you, I don't care where their degree is from, don't let anybody tell you that the Fed is going to raise rates and cause cap rates to go up. That is a complete ignorance of how bonds work. The 10-year treasury is what causes cap rates to go up or down, and there's only one thing that makes the 10-year treasury go up, and it has nothing to do with the Federal Reserve, and that's the expected rate of inflation. The only way the 10-year treasury will go up and start trying to push cap rates up is if the whole world comes to a consensus that we're going to have high inflation in this country. And I'll show you the facts here in just a minute. The other thing is the oil and gas industry is rebounding, which is going to be good for the economy because the automotive business is at a peak right now and starting to slow down. Not slow down, it's just peaking. It's not going to be a source of continued job growth like it's been for the last 3 or 4 years. But as it's peaking, the oil and gas business is coming in and starting to rebound again. And not only that, but single-family housing construction is too. That's why I think we're not at the end of the game. That's why I think we have at least 2 or 3 years of continued economic growth before we have a recession. I also believe we're in a new bull market for single-family housing. Nobody believes me on this one too. And I talked to a bunch of people that own tons of apartments, private equity people doing apartments, luxury apartments inside the loop that are renting for $2,000 or $3,000 a month, that sort of thing. And they don't like to hear it when I say we're for a new bull market in single family housing. But I'm telling you, people want to buy homes again. And I got news for you. If you're a millennial or you got a millennial at home or you got friends that are millennials, things are going to get a lot better for you right now, very soon, because I'll give you an example of my shop. It explains all of it with one example. Working at the real estate center there, I had a staff of PhDs and a lawyer. One of our lawyer there in 2008, he was 65 years old and ready to retire. And then his stock portfolio went down 40%. And then he wasn't ready to retire. He just retired about 6 months ago, finally. And now 8 years later, he's 73. What happens when the 73-year-old at the university retires? A 32-year-old PhD replaces that person and they'd been driving a car at Uber and making $20,000 a year, and now they got a PhD job at a university that pays $135,000 plus benefits. My hypothesis is that makes that person more attractive to the opposite sex. And when that happens, marriage tends to occur. It still does. I'm old school, I understand. I wear wingtips, I drive a minivan. I'm totally out of date, I understand. But it still can happen. You still can get married, and then you can have children, and then all of a sudden you got children that want to go to soccer practice and the pool for swim practice, and you're going, man, how's this going to work, hon? Let's see, we put 2 kids on the back of our bike, we got the 3 helmets, but I'm not sure I can get there, so I think we need to move and buy a house. And then the worst of all things, I like to make millennials kind of mad a little bit after dumping some good news on them. Saying, and then after you buy that house, the next thing that happens is you buy a minivan, like me. And I've had people go, there ain't no way. I liked you until you said that. I will never, ever own a minivan. It's so funny because some tall 35-year-old woman in Washington, these 2 other ladies said, I bought a house. I'm thinking about buying a house. And I said, what about the minivan? And they go, no way, no way. And the tall lady slightly behind them, she was doing this. And she goes, I have a minivan. They're so big. Okay, so anyhow, millennials are going to get jobs. As the baby boomers retire because their 401k is now sufficient, or their health is to the point where it doesn't matter what your 401k is, you're done. And over the next decade, all kinds of 30 to 35, 40-year-olds are going to be getting a good job, paying a lot of money, and they're going to start buying houses. A Pew survey in December, I like this, it was interesting, whether I like it or not is irrelevant. 72% of people renting right now say they want to buy a home. So forget that idea that somehow that millennials are different. They're never going to buy homes. They're going to ride bikes the rest of their life. But before you get too excited about and dump off all your multifamily, we got a problem here with affordability and financial issues. The student loan thing is huge. $1.3 trillion. We have unloaded a travesty on this generation. You know, about truth in lending, we need to have truth in education. We need to tell people what kind of earnings they're going to get when they select their major. It's fine to major in archaeology. It's fine to major in ancient Russian literature if you like. Those are all good. I like education. Power to you, but don't borrow $100,000 for that degree because you're never going to pay it off. And universities should tell you that. Shame on them for not. An analysis of 1,000 colleges and trade schools showed that at least half of those students had defaulted or failed to pay at least $1 on those loans for the last 7 years. You've got a whole class of people out there that have been foisted on a hoax, and they borrowed a ton of money for an education that's not going to be able to be paid back, and they're in a permanent status of not being able to buy homes. Your government's going to change that. I guarantee you. The Federal Reserve and the Securities Exchange Commission, they're going to make it happen where it's like, okay, fine. We don't want you to never buy a home just because you got a college degree. We're going to figure out some way to create a way to make sure, even if you're in delinquency on that student loan, somehow or other, you're going to be buying houses. You just wait and see if it doesn't happen. Fiscal policy, this is Trump, if you will. This is politics, if you will. I don't like that. I don't like Trump, and I don't like politics. I do like fiscal policy. Trump's policies are to reduce regulation. That's why businessmen and women are so ecstatic right now. He's also talking about tax reform, lowering tax rates for individuals and corporations. That would be pretty bullish. People would work. It would encourage people to produce and create jobs. And he's talking about spending $1 trillion to build bridges and highways and stuff. My thought is none of that's going to happen. And the reason is because if you want to cut tax rates, you're going to have a gigantic federal deficit. Anybody know anybody that's come up to him and go, hey, I'm real comfortable with this 20 trillion in debt. I think that'd be great if Donald Trump would raise our debt from 20 trillion to 30 trillion. Anybody heard that? I haven't either. Nobody. And Congress is full of people that used to be called the Tea Party, that now are called the Freedom Caucus, that are there for a reason, and that is don't vote for anything that increases the deficit. So what that translates into is like, I'm Grover Norquist. I'm kind of the ringleader of this, and I'm glad. I don't want a $40 trillion federal deficit that bankrupts the country. Fine. So I'm Grover Norquist. I can just see this conversation with Trump, like the day after inauguration. He shows up at the White House. He goes, Dawn, can I call you Dawn? You know what? My impression is you got a pretty big ego, and you want to build $1 trillion in bridges, and you'd like to cut business taxes and personal taxes. How you going to pay for that, pal? And Donald Trump said, well, I don't have to. I'm big enough. I can do what I want. I got a mandate. And Norquist says, yeah, but let me tell you something. All these people in the House, all these people in the Senate that signed that pledge, not raising the deficit, they're there for a reason too. They got a mandate from their people to not raise the deficit, and you can't touch them. Because if they do vote with you to raise the deficit, they'll get fired right on the spot because they signed a pledge not to do it. So these people aren't going to work with you, period. If you want to build a bridge, pay for it. If you want to cut marginal tax rates, pay for it. If you can't, it doesn't happen. And we've already seen that with healthcare. That's already come out. Funny thing is, about 2/3 of the things I predicted in November have already happened. I'm about ready to just quit for the rest of the year and say, hey, see a speech I gave about 2 months ago. I'm in a conundrum right now. I'm not quite sure what to do next month. But you just saw it with healthcare. I mean, what you just saw with healthcare is going to be 9 times stronger with tax reform and building $1 trillion worth of bridges. Ronald Reagan's the last person that got real tax reform. That was 31 years ago, gang, 1986. And Reagan, as charismatic as he was, only got half the job done too. He got the tax rates cuts. I love that. I've been enjoying it ever since. But he couldn't get the spending cuts to pay for it. And so we had this huge federal deficit for years. And you see, if Ronald Reagan was president today, and as lovable as he was at that time, popular as he was, he would not have got that tax reform either. Because Grover Norquist would be standing there saying, Ronnie, here's the deal. Sure, you want to cut the marginal rate for individuals from 50 down to 28? We're in favor of that, but you got to pay for it. So cut welfare. Okay, cut subsidies to farmers. Get rid of the deduction for tax-exempt municipal bonds. You think your mayor would vote for that? You think all the people from New York and California would vote to get rid of being able to deduct their state income tax off their federal returns? Do you think the oil and gas people will vote to get rid of all their tax subsidies? Do you think retirees would vote to increase the retirement age on people that are like 2 years old right now? Do you think Medicare people would vote to cut a little bit off of Medicare? Answer is no, 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 and no. And so as this all boils down, this is why interest rates started to go up in November. And the media is like, oh my gosh, how long of a memory do we have in this country now? It's like, is it like more than a month? People just forgot about the Tea Party and forgot about this Freedom Caucus there. And so what happened was Trump gets elected and the stock market goes way up and the interest rates on the 10-year Treasury start to go up, and people started looking at me like, see what's happening? You said rates weren't going to go up, and they are. And I'm looking at that going, well, okay, weird. But what happened was you had this pendulum swing from we're not going to ever do anything in this country anymore to after the day of the election, we're going to do all kinds of stuff. We're going to grow 4% a year. And we have a labor shortage already, and so that's going to be inflationary. And so the 10-year Treasury went up quite a bit, like from 2.2 to 2.6. Now what's happened in the last month or two? People are starting to wake up. This euphoria, this post-election euphoria of business that took way out over here was way over the top, thinking all this was going to happen. And now reality is starting to sink in that we may not build one bridge. I don't guess we're going to get any tax reform, period. The only thing we might get is regulatory reform, which is good enough. And as you start, if you throw away tax reform and you throw away building bridges, you have an economy that's going to grow more like 2% rather than 4%, and that's not inflationary, and inflation's what drives that 10-year Treasury. And every day that goes by, that 10-year Treasury just keeps sinking and sinking and sinking. And so mortgage rates are going to have been dropping. They should have, and they will continue to drop as that 10-year Treasury. So what I'm saying is, that sounds kind of not optimistic. That's fine. I'm not an optimist or a pessimist. I told you I'm not a cheerleader. I don't care about that. I'm trying to figure out if interest rates are going to go up or down or not. And here's the good news is, if Trump doesn't build one bridge, if they don't have any tax reform at all, but they do get some regulatory reform that's helped businessmen and women do better and have a more optimistic outlook, our country will grow faster than it did last year and the year before, and interest rates won't go up at all. I call that a pretty good deal. We keep creating jobs and no inflation to speak of, and interest rates go nowhere. I kind of like that outlook. As we speak, my opening slide was approaching the red line. If we did bridges and tax reform and all that, we would have gone over the red line. And now that we're backing away from that, we're not. We're just going to be in a nice hot rod that's driving 70 miles an hour and not going to blow up. I think it's a good environment. So don't get disappointed if we don't get tax reform and we don't build any bridges, because we don't actually need it right now. Our economy is virtually at full employment as we speak right now. This labor shortage could create wage inflation, but other factors are keeping inflation down. Number one, apartment rents are starting to flatten out. Apartment rents are 35% of the CPI. So if apartment rent went flat, 35% of the CPI would be zero. Another reason the CPI went up in the last year is because oil went from $40 to $50 a barrel. Oil isn't going up anymore after that. If it stays at $50 a barrel, there's no inflation there. So my theme was, and man, I caught a lot of raised eyebrows about this because everybody's saying, oh, the Fed's going to raise rates, so everything's going to go up. I've been saying the 10-year Treasury and cap rates are unlikely to increase much at all. I'm not selling out of my CREF commercial real estate portfolio. I'm not getting out at all. I didn't get out in 2013 when all the bright lights in the world said interest rates are going to go up, cap rates are going to go up, you better get out. I'm not getting out now, because if we don't get tax reform and we don't get bridges, we don't have much inflation, and cap rates are going to go nowhere. And like I said earlier, everybody on this planet wants to own real estate in the United States of America. Let me show you some facts. This is the index of leading indicators. It's a good predictor of recessions when it goes below zero. It's pretty good at saying, predicting we're going to have a recession. This indicator is showing no hint of any kind of sign of oncoming recession. This slide is just as bullish as it can get. I get goosebumps when I look at this slide. It's kind of a sad state of affairs at age 63. I used to get goosebumps when a girl in a miniskirt would walk by, and now it's just slides like this, okay? But hey, I'm comfortable in my own skin, you know? Every month in this country, somewhere between 100,000 and 300,000 people get a job. And they're getting wages, and they get salaries and incomes. What do Americans do when they get a job and they get income? They sure do. That's our competitive advantage. Nobody on earth can outspend an American, okay? And here's where the labor is short. I know you could say, well, that ain't what I heard, buddy. I watch Fox all day long, and once in a while, just for sport, I watch CNN just to get madder than I am already. And nobody's telling me there's a labor shortage. All I hear is everybody's unemployed and this country stinks. Wages have been going up for about the last 2 years. That's what happens when you don't have enough workers. You have to outbid them to get enough workers to get your job done. That's the biggest threat in our country for higher inflation is wage increases, and we need more workers. Consumer confidence, I knew business confidence was off the chart because I saw it. I mean, I was amazed just at how ecstatic everybody in the business community was. But this one surprised me. Look what happened to consumers. I mean, if you watch TV, and I do watch a little bit just so I know what other people are thinking. I'm trying to figure out where did you come up with that idea. It's like, oh, I saw that. Okay, I saw that on TV. I got it. I would have thought that consumers are just moribund. They're in mourning. Our country's in shambles. Our president's horrible. Everything is bad. Consumer confidence exploded. And it exploded again last month. The American consumer is as ecstatic about economic future as the business community is. Small business hiring. This is a percent of people say I'm going to hire in the next 3 months. This is what drives buildings to fill up. This is a proxy for absorption for anything you want to talk about. Small business hiring is still at a very elevated level. It's not going up anymore. That's what happens when you get later innings. When you get out to year 10 of an economic recovery, not everybody's hiring as much as they used to be, but it's still strong. And this just came out a couple of days ago, the first quarter. This is the roundtable, business roundtable, the big corporations. Look what's happened to their enthusiasm level in the last 3 months. 41% say they're going to hire. Only 18% say they're going to lay off. This is a groundswell. This is unprecedented. Don't underestimate the enthusiasm that's going on in this country. In fact, it's overdone, I think. I'm starting to hear people in the last week or two, maybe 2 weeks, say, hey, kind of got excited there and everything looked like it's going to go full blast and everything. Feels like people are kind of backing off just a little bit here in the last 2 weeks. I've heard that more than once. I don't know if it's really happened or just a few people made the point to tell me that. It's too early. I don't know yet. But what I'm telling you is most likely if that's the case, the only thing that's happening is after the election, the enthusiasm's pendulum swung clear out to here. And we're going to grow at 4% a year with all these things that Donald Trump's going to do. And now we find out that Congress isn't going to allow him to do a third of what he wanted to do. And so expectations are getting scaled back down to normal, which needs to happen. But if you were here a month ago and now you're down here, you're kind of thinking, wow, things aren't quite as rosy as they were a month ago. I think that's normal. I think people are just starting to get normal expectations that they forgot there's more than a president that has to do things to make things happen in America. This is the percent of businesses say they're going to make capital expenditures, and that's skyrocketing too. Their confidence in America's future right now hasn't been this high for a long time. And here's another good one. Corporate profits in America, for several years I was warning people, it's like these corporate profits are going down. This is not good. Because businesses start firing people when profits go down. The good news is now for about the last 3 quarters, corporate profits are going up again. That gives businesses incentive to hire even more people. That's why their outlook is pretty good too. Right now as we sit here today, you don't see this on any news media because it's good news. 5.6 million jobs open today. All you hear is about how people are underemployed. Woe is me. I've been putting this up now, this chart up, every month. It gets updated for about 18 months now, and it was 4.1 million jobs open back then when people said, oh my gosh, nobody's got a job. It just keeps getting bigger. Last month it was 5.5, now it's 5.6 million jobs available right now. Don't get me wrong, there's people that aren't working in this country, but I'm just telling you, I don't care about that. Either they can't because they don't want to, or they can't physically, or whatever their reason is irrelevant to me. What is relevant is with 5.6 million jobs open, that means you're going to have to outbid them to get workers, and you're going to raise pay. And that's good, as long as it doesn't get too far out of hand. We also need legal immigration. If you're kind of thinking, I'm kind of a Democrat, and this guy kind of irritates me a little bit, I'm not quite sure why, I'm just going to irritate the Republicans in the room by saying we need legal immigration here because we got a shortage of labor. If you're in the trucking business, the construction business, lots of other businesses, it's hard to find enough people to work. And trust me, most Americans in this country aren't in favor of legal immigration either. I get blowback from that. It's like, hey, I don't care what it is, I'm not in favor of immigration, period. That's the dumbest thing I ever heard of, but it's just the way it is. It's the way we live, you know, it's what we do. The unemployment rate is back down to nothing. Janet Yellen she could put a flag up and say, I did it, I succeeded. I got unemployment down to 4.5. I don't need interest rates to be 0 anymore. I can start raising my Fed funds rate, and that's what she's trying to do. So with that said, I just want to say this. The 10-year Treasury that's tied to cap rate movement, like I said, is fundamentally tied to inflation. And I want to show you these two slides. This is the actual inflation rate in America, and that goes back to 1920. What you can see from this is for the last 30 years, inflation's been running about 2 to 3% a year. We don't have 5 or 6% inflation in this country anymore. And so inflation's basically been going nowhere, and that's why interest rates have been so low, because that's the only thing that causes the 10-year Treasury to go up. This is a survey of maybe 100 economists who have a 50% chance they don't know what they're talking about. But when you put 100 of them together, it looks impressive, okay? And when Janet Yellen goes to Congress every 6 months, she tells Congress, we feel that inflation expectations are well anchored. And that's code word, meaning I looked at this chart and nobody thinks inflation is getting out of hand at all. And so interest rates on the 10-year Treasury are likely to go nowhere because people don't expect inflation to go anywhere either. And so just because the Fed is going to raise an interest rate on a 24-hour loan from one big bank to another has nothing to do with the 10-year Treasury. As long as this inflation expectations is well anchored, that means the 10-year Treasury is likely to go nowhere. In fact, the Fed is raising the one-day rate, and what's happening to the 10-year Treasury is going down. Alan Greenspan called that a conundrum in 2004. That's a cuss word if you're chairman of the Fed. That's as close to a cuss word as your governmental affairs people allow you to say in public. And the conundrum was he raised the one-day rate and the 10-year went down. It's like, I'm trying to raise all interest rates because I want to slow the economy down. I'm raising my one rate and that crazy 10-year is going down. And that is a conundrum. It's not supposed to do that. And he had no control over it. It's happening again right now. I don't want to talk about this. Too much time. Actually, maybe I do. If you're worried about runaway inflation, and you got clients that do, trust me, I know. I live with you. I live with people like you for the last 18, 19 years, having lunches and conversations with this. I'm going to give this presentation to the organization, and they've got my permission to email it to you. So if you want to see these, those little boxes down there is the rate of inflation in each decade going back, I think it's to the 50s. 1.8 for that decade, and then 2.6. But then in the 70s, we had 7.2, and that's where people think of the past. And in the 80s, we had 5%. In the 80s, we had 5% for the whole decade, but it was all in the first 2 or 3 years. It was over. Inflation was over by 1983. So the actual inflation in this country that everybody's nervous about happened from about 1974 to about 1982, and after that, nothing. 2 to 3% a year. The only way we get massive inflation is if somehow or other the price of oil goes back up to $100 in a short period of time. And the only way that's going to happen, here's the black swan. If you ever heard about the black swan event, that's an event that nobody can predict. It just caught everybody off guard and has a huge consequence. My black swan is that the Saudi Arabia government gets overthrown because they can't pay their bills because oil's too low for them. And if the Saudi government happens to get overthrown and their oil production gets cut in half, the price of oil could go to $100 like overnight. So just keep watching out of the corner of your eye there once in a while. If you happen to see a CNN thing, this is what CNN does in spades, like, we're live from Riyadh tonight here and blah, blah, blah. If you see 500,000 people out in the streets of Riyadh mad because they're not getting their subsidies, that is the potential there for that government to get overthrown. And if it does, it'd be kind of like Iran getting the Shah getting overthrown for an Ayatollah. And if that happens, you can lose half of the Saudi production, and that's when oil goes to $100. Whether that happens or not, I don't know, but it's on the table. Here's another reason. If you have a customer that's balking at cap rates, show them this chart, say, Chauncey, I think you're right. If I were you, I wouldn't buy a multifamily at this kind of cap rate, or a freestanding net lease, triple net at this kind of cap rate. I think what you should buy is probably Japanese 10-year treasuries with a negative yield on them. That seems like something that might be good for you. Or maybe you want to invest in stocks, because this is margin debt on the New York Stock Exchange. It's never been higher. Margin debt is borrowing money to buy stock. It's about 80% correlated with the market. When people borrow money to buy stock, it goes up. When people unborrow money to buy stock, it goes down. Record highs, you can look at this on your own time there, but that first peak is on the left side. That was March of 2000. The Dow was at 11,200 or 300. 2 years later, it's at 7,400. The second peak was in July of 07. The Dow was at 14. 2 years later, the Dow was at 8. I conclude from this chart, buying stock when margin debt's at a peak is not a good idea. And so people that balk on buying a triple net because cap rate's a little low, this is what their options are. The negative yield on a Japanese treasury, they can buy bonds with virtually no yield, or they can buy stock at record high margin debt. That's why I'm still 85% commercial real estate. The converse of this is when the margin debt gets sold off, if I happen to be giving a speech here at that point, I would say to you, you got a competitor now, gang. Commercial real estate has a viable competitor because the stock market is suddenly attractive again. As long as the bond market is not attractive, the stock market is not attractive, it's either gold and cocaine or real estate. And let me hit this just a minute, and then I'll go to Q&A. This is just an example. I could give you 10 examples of institutional demand. Hedge funds have performed poorly compared with the stock and bond markets since 2009. 8 years hedge funds haven't done well. In fact, one of the big guys, Eric Mindich, is having to close his fund because he lost 9%. They pay him enormous sums of money to run a hedge fund, and he lost 9% while the Dow or the S&P was up 12%. Now, why do I say that? Because big pension funds and insurance companies and endowment associations, they own stock, they own bonds, and they own alternative. Alternative is composed of real estate and hedge funds, largely. Commodities too. They still buy commodities occasionally and lose a ton of money on that. So what happens is pension funds, insurance companies, endowment associations are dumping out of hedge funds as fast as they can get out. And that box of alternative investments mainly is the alternative is to dump out of hedge funds and replace it with more real estate. And they don't care what the yield is. They don't care what the cap rate is right now. It's because we're going to change our allocations. And these last two slides, an old economist told me that every economist should use the words "in conclusion" in their speech to give their audience hope. So, in conclusion, my last two slides, an example. This is endowment associations. Lost 1.9%. The stock market went up 12 and endowment associations as a whole lost 1.9. Why? Because they had a bunch of hedge funds and they had a bunch of commodity funds and they had a bunch of international stock funds, and all of those lost a ton of money. Let me show you what happens here. The worst performers were hedge funds and international stocks. Here's the good performers. I'll do them in reverse order. Bonds. Nobody wants to own bonds. All the smart people say, oh, you can't own bonds. Interest rates are going to go up. Those pension funds that lost, those endowment associations that lost money actually had a positive return on bonds of 3.6. They had a positive return on private equity investments of 4.5. And what was the breadwinner? What was the big all-star performer of all endowment associations and by definition insurance companies and pension funds? That would be commercial real estate. That's why when that kid from CII came back, ran 500 Monte Carlo simulations and found out that they couldn't outperform my portfolio of all commercial real estate. That's why, because it's working best. And it will continue to go. People ask me, well, when does this end? And it will end when commercial real estate has a viable alternative. When you can come up to me and say, hey, here's a gigantic asset class. It's only can be stocks, or bonds, or some international stocks in Brazil or Russia. You come to me and say, all of my customers are starting to invest in stock in Russia again. They're selling their commercial real estate so they can buy stock in Portugal or in Brazil. When that happens, that will be the peak of the commercial real estate cycle. And right now, as we sit here today, we're nowhere near that. Everybody wants to own real estate in this country, and it's going to continue till there's a viable opportunity, and I don't see that coming anytime soon. So with that said, I'm going to close my remarks. We got time maybe for a question or two. Anybody got a question? Yes, sir.
What is the threat of war or possible warfare have on all of this?
I tell you what, if that numbskull in North Korea does something dumb, all bets are off at this point. Yeah. That's one of those total outliers. It's like lightning striking. If it happens, it's going to hurt. And I don't know. That guy seems like he could do it. So maybe there's some risk associated. But if it does, here's the thing about it. Let's say that guy blows himself up with an atomic bomb. Our stock market drops 20%. Maybe he launches a missile that goes into the ocean 50 miles from Japan. Our stock market, and we do something big. We come back at them hard. Our stock market could drop 20% in a day or two over that. But what I'm telling you is don't sell anything, and don't sell any of your real estate either. Because just because the stock market goes down 20% doesn't mean that the value of the buildings that you own that are full of tenants here is going to go anywhere. And just know that no matter what, if Saudi Arabia gets overthrown, or if Numbskull throws off a bomb and we go blow him into smithereens, that's not going to have a long-term effect on the value of real estate. I can't think of what I want to own more than a Class B multifamily unit that's fully leased up and got a nice 4% mortgage on it, a 70% loan-to-value ratio. I can't think of something I'd rather own rather than real estate. Just write it out. A lot of these things can't be predicted. And if they do happen, just remember, I'm not lying. Nothing I've said is lying, period, or exaggeration, period. Everything I've said about the United States being the place everybody wants to invest and real estate is the top performing asset class, all of that is 100% red gold plate true. And as long as that's the case, that commercial real estate is as good a place as you can be no matter what happens around the globe. One last question? Yeah, go ahead.
You throw it in a basket of commercial real estate. You have the different food groups in the commercial real estate basket, and you see warehouse distribution doing quite well, in fact, with the way retail's going. You see strong growth in the office market. The bases, the tenants, they're all expanding. Small businesses expanding. And you got a multifam that's been going gangbusters for years. Your own slide has the primary tenant base wanting to buy homes and transition out of rental housing. The price level here is now at par, new construction, so your competition's unlimited if they keep on building. Where do you see it all shaking out?
Well, here's the thing. I have a saying in Texas, and I bet it applies in a lot of places. There isn't a positive upward trend in absorption that Texans can't overbuild. I just think that's part of the real estate game. You know, maybe you got room for 3 new deals, And if people can get money to do them, there's going to be 6 of them come online. That's just kind of the nature of capitalism. For me personally, when you want to break down the food groups, and this is just my own personal feeling, to me, industrial multifamily are my 2 favorites. TIAA-CREF just bought the big fashion mall in Las Vegas. I was sorry to see that happen. A kid asked me, what do you make of that they bought this big mall in Vegas? And I said, that's a sign to me that they got too much money flowing in and they're stretching to find a way to put $1 billion to work in a short period of time. I would not want to own, personally, malls all that much. Retail's under duress big time. And so I'm not saying don't own it, but just be sure you get a risk-adjusted return for owning it, because there's risk associated with it. And office, I'm good with office. It's just that it seems like whenever I talk about office with investor types, what I keep hearing back is the cost of tenant improvements when the leases roll. And I don't know if that's the nature of these institutional owners. They don't like to come in and have to put $500,000 in for tenant improvements when a tenant runs out. But just from my own personal point of view of observing investors, it looks like to me industrial, as we say here today, industrial is kind of the preferred group. Multifamily would be second, because people are worried that expensive multifamily is overbuilt already, and I think it is. That's why I like Class B and C multifamily. And then I would put office next, and then I'd put retail next after that, just because it's riskier. I'm kind of a risk-averse kind of person. But the nice thing is that's opportunities. Not everybody in this room is risk-averse. I totally know that. That's why you're in this business. And so if you're willing to step up to the plate on that, usually when there's risk, when there's people like me that are nervous, that means there's opportunities to be had for people that know what they're talking about. If you know retail, you can come in and buy it, take advantage of people like me, and buy it from me who's nervous, and fix it up and fill it full of tenants and make some money. So yeah, thanks for that question. I think maybe I should quit now. I just want to thank you for your kind attention, and I hope you have a great 2017. Thanks for coming. Thanks, Phil. Great job. Sure, a pleasure to meet you.